Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's September 6, 2019. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. Today we are joined by Daniel Want from Prerequisite Capital to share his views on how to navigate the changing investment landscape and the risks moving forward. For our WTF segment, Sam Zell doesn't think the hard stuff will come down for a while yet.
And this week in trading history, we look back at long-term capital management, and then we get to our top 5 things to watch this week. Now, before we do get on with the main part of the show, just a couple quick housekeeping things. Those of you that are in the Toronto vicinity and would like to join us for the TMX-sponsored Options Education Day, it is on Saturday, September 14th. There are still tickets available, so if you do want to grab a seat and join us, you can just go to the Montreal Exchange website. As well, the week after, there is the Money Show in Toronto with the All-Star Options. I'm doing a number of speaking events there as well. And so you can also just look up the Money Show Toronto on the 20th and 21st. But something else is happening that weekend, isn't it, Kev?
That's right. I won't be joining you at the Money Show, but I will be joining you Friday, September 20th at 7 p.m. at the Rec Room in Toronto. And what this is, it's the Market Huddle meetup. And everyone is invited.
Tell them how much the ticket costs.
$0.
That's right. They just got to show up.
Just show up and drink beer. No sours allowed. That's the only rule.
That's exactly the only
One rule. Everyone knows the rules. No sours allowed. And Shy Girl is going to be joining us. Tracy's going to be there as well. She's speaking at that same show that you're speaking at, Patrick. So she promised to come out, and those should be a lot of fun. And we encourage everyone to come out and chat about the markets.
All right. So, Lena, jump on here.
Hi.
Hey, Lena. So, listen, who's our sponsor this week?
Our sponsor this week is another one from Collective Arts Brewing Company, Stranger Than Fiction Porter.
A port. Ooh.
I actually have never had a porter, I don't think.
Oh, yeah. Well, we're in for a treat, aren't we?
Well, it says...
So what are we about to experience here? Do you have a description or anything?
Yeah, so it says this porter shows an opaque brown and black color with thick, long-lasting head. Complex aromas of molasses, coffee, smoke, toasted nuts, and chocolate. Malty and powerful on a palate with a creamy mouthfeel. Smoky notes linger on a lengthy finish.
All right, let's see what we got here.
There's so many things that you could say to that. I'm just going to let them all go by. I'm glad you read it, not me.
Wow. Now, this is like a... Wow.
Is it lingering on your mouth, Patrick?
Yeah, no, it's thick. It's like putting Nutella on your tongue.
It tastes like, if an alcoholic really wanted a beer. Or not a beer, sorry, not a coffee. That's what I meant.
Oh, an alcohol because it's thick. I could taste the coffee flavor in it. That's for sure.
Oh shit, Patrick, you're just walking into so many of them. I'm just gonna let that one go as well. Okay,
why don't you give us your disclaimer?
Yeah. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. For more information, please visit eastwestfunds.com. Side effects of too much Market Huddle may include headless shoulder migraines, Fibonacci anemia, and deafness to common sense.
Oh my God.
That's both suffering. I
suffer from that for
That's
sure.
what Mrs. Macro Tourist tells me every day of the week.
All right, let's get Daniel on the show. All right, now joining us is Daniel Want from Prerequisite. Let me try that again, Lena.
I told you wouldn't be able to do it. First take. Right. Let's see if he makes it on the second.
All right, here we go.
I'm a seller.
All right, so joining us now is Daniel Want from Prerequisite Capital. He's the co-founder and portfolio manager there. Daniel, how are you doing?
Yeah, good. Thanks, guys.
That's good. So you've come to you created a nice slide deck presentation that for us to share with all of our listeners, and I thought it was great what you put together. So I'm looking forward to going through all of this with you. So one of the first things you put on here is the idea that the next 25 years is not going to be anything like the last 50. And so why don't you share with us what's on your mind and where you think this is all going?
Yeah, sure. No, just like everyone else out there, we've all been loosely wrestling with the same sort of issues and how do we navigate things, given the fact that there is so much going on out there and we're sort of dealing with the overhang of, a multi-decade global indebtedness cycle. And, we're talking about all sorts of, and actually trying out all sorts of extreme policy measures. And they only appear to be, set to get more extreme as the years unfold, and we need to deal further with the different imbalances and unsustainabilities that have built up out there in the system. And so, for the last 50 years, we've generally had tailwinds, at least in most of the Western world and even in the peripheral world, of obviously a never-ending debt cycle. We're always expanding credit, and we're always moving in the direction of sustaining investment structures and economic structures. God forbid we'd have any form of a material washout and reallocate resource to more useful purposes.
Now, Daniel, so I wanted to ask you this, and so when to me, and what I kind of look at this zero or negative interest rate policy that we are seeing out there in that environment is this period of financial repression. What's your intuition as to how you think that this kind of ends? Or do you believe that it's just going to perpetuate for a decade longer, just in the same state that it is? Like, do you think that there's a transition point coming?
Yeah, I mean, when we look further out, my suspicion, I wonder sometimes whether these bond markets will end more in a whimper, but the currency markets will end in a roar, because governments just cannot, they're not really going to be able to allow, especially sovereign bond yields, to materially get out of control. And the nominal yields in their sovereign debt, they have a lot of measures, and even if they do just directly buy them, but obviously what they can't control is their currency, and what they can't control are the capital flows past a point. They can try and put capital controls in, and unfortunately we're probably going to go into a world, at least over the next 10, 15 years, as we're more, we're dealing with a lot of these issues, where capital controls will start to predominate more and more, especially in the rest of the world, and maybe between the major financial centres, like the UK, Australia, or not Australia, but the US, and just some of the, there'll still be reasonably free movement of capital, I'd imagine, but it will be more, on a selected basis, and there'll be qualifications to everything else, right. I'd guess.
So on page 5, you do a great job breaking down what you define as like the 7 primary risks in the markets, and they all make perfect sense. But you particularly highlighted portfolio risks and the fact that, or the risk of insufficient diversification. Why did you highlight that one as the key risk that you wanted to kind of bring to people's attention?
Yeah. Well, actually, this is just an image that I threw on from a different presentation. But basically, when you look at the way the average portfolio is constructed, it's largely optimized and quite efficient for the last 50 years of experience, right? And whereas the next 25 years of experience, I'd imagine, are going to be very different. And when you look at pretty much any asset class, any market, even pretty much any currency, they all map to a different combination of, growth or inflation and capital flow type, underlying factors and drivers.
Right.
And so one of the things we know is that, over the next 10 years, we are naturally going to only morph into a different combination of growth, inflation, and capital flow conditions, right? Really, all we experience in markets and portfolios is just a rearranging of those, three primary factors. And so when different factors are, improving or deteriorating, different asset classes or different markets tend to, move up and down in line with those things. And so if we know that in any given point in time, like tomorrow we wake up and, say there is some form of a crisis, or there's actually more of a positive shock, whatever it is, if growth is declining or we're moving into some form of a recessionary condition, then cash tends to be king. If growth is improving, then equities is largely where you want to be. If we've got deflation, then it's the, sovereign bonds, especially duration, longer duration sovereign bonds that have, governments that have a lot more room to move. And so don't necessarily have the sovereign credit risk as pronounced. Excessive inflation, precious metals, you get the idea. And so if we start with a foundation in portfolios construction, at least in our liquid portfolios, where we've got those primary elements, then that gives us a degree of resiliency and even uncorrelation to most things that move. So whatever we get surprised with, it will naturally prove, a degree of resiliency.
So, Daniel, I love this idea of insufficient diversification, because I've personally been skeptical of the way we have always diversified. Like, I want to know what you define as diversification, because during a liquidity crisis, where the scarcity is in cash, the correlation of all assets during some sort of a liquidity event all go to one, and everything goes down simultaneously. And so all of this mapping you do of correlations just gets thrown out the window. Like, how do you properly diversify to remove that kind of a risk?
Yeah, well, what we're really talking about is not necessarily correlation when we start to talk about, say, a liquidity event. And this is where having more of an understanding of the systems nature of the world we live in is more important. So understanding the plumbing of the banking system and how all of that works, because ultimately you only ever have two categories of asset, so to speak, or categories of securities. You have either confidence assets or collateral type assets, right? Now, in this 7 primary risks, for example, 3 of those, so cash, sovereign bonds, and precious metals are more of your historic sort of typical collateral type assets. So in a liquidity crisis, what are you going to be scrambling for? Collateral. Well, that's what everyone's going to be scrambling for. And so half of the strategy here in trying to build in a degree, or at least a foundation of resiliency, is that you're going to own a bunch of collateral before everyone else realizes they need it, right? Mm-hmm. And so in the midst of a liquidity crisis, and this is where a systems understanding of how things work is pretty essential, because what is collateral and what is a confidence asset will change in different systems regimes. Right. Once upon a time, or depending on where we're at, real estate can be a collateral asset, right?
Right.
And if it's not underpinned by a whole world of unsustainable and excessive credit. And so a scramble for collateral, especially if you're in more of an inflationary environment where a scramble for collateral is more towards, say, precious metals or real estate that's not underpinned by a big, credit excess. Whereas in other systems regimes, the collateral asset actually, real estate is more of a confidence asset, and it's going to get smoked because of the credit structures underneath it.
Right.
And the same goes for currencies. Currencies fundamentally by nature, depending on the context that they're in or the broader system structure that they're in, they'll either tend to be more of a confidence type currency in the world, or they'll act more like a collateral type currency in the world. The Swiss franc for a long time has kind of been a bit like that. The yen up until now has kind of a little bit been like that in past regimes. The US dollar definitely now is the ultimate sort of collateral type currency. And so it actually has a couple of things working for it in that, generally it actually can benefit in confidence and collateral demand type conditions because of the way everything's wired.
So do you still believe there's room for the U.S. dollar to continue the uptrend? Do you have a stand on what you think the U.S. dollar is going to do here?
Yeah, it's sort of like all roads lead to Rome. It's all roads lead to the US dollar. Ultimately, as this structural environment unfolds, at least in the initial phases, past the point in the years ahead, you're going to want to run from the US dollar. But I think a lot of the context, or at least a lot of our frameworks and the analysis methodologies, it's just that drive towards the US dollar on a multi-year basis is quite unrelenting.
Kevin is in the safe haven of the pound sterling. That's
you couldn't resist getting a dig in there. Daniel, we're having a look at page number 8, and I must say this is a chart near and dear to my heart. And what we're looking at is the 30-year Treasury, and then you have some sort of tool that you have for measuring liquidity turning points, and you have minor and major signals, and it looks like one of the minor signals was just hit. And why don't you walk us through what this is meaning, how you come about figuring out when those things are hit, and what it means for the bond market going forward?
Yeah, so in the slides leading up to that, I kind of provide a bit of a synopsis about the underlying theory. So like when any marketplace starts to lose a degree of diversity amongst the positioning of its participants and what's been working for them and all the rest of it, and nothing rewards or nothing reinforces a view or a positioning or a trading strategy like a gain, right? And so when market the fundamental or the underlying market structure starts to move to a highly unified state, that's when that market actually, everyone's bought, everyone's a buyer, all of the bears have basically been punished and they've capitulated and thrown the towel in. They've probably been trapped much lower anyway. When it moves to that point of
well, I have to jump in here. Let's double check. Kev, are you flat now on bonds?
No way, baby.
No. See, then this indicator is wrong.
No, that everyone's covered. I know. I've taken stabs at it, but let's just finish, Daniel.
All right, so go, Daniel. Sorry for interrupting. Go.
How do you get,
so it basically identifies a critical mass. So the maths under that is more like using fractal type math, and trying to a lot of the stuff I've learned about market positioning and how participants behave and structure and all of this sort of stuff. I was able to crystallize into basically a fractal type algorithm. So it identifies critical mass conditions, and at those critical mass conditions, you get a high probability of some form of a turn. It's almost like when there's a diversity of positions and views and argument almost in the marketplace, that's almost like an abundant liquidity condition. But when you get a lack of diversity and unification and excessive unified positioning and all of the rest of it, that tends to precede a shift or the significant turns in markets. And so now, some of the work
so Daniel, from your lips to God's ears, hopefully, because I'm about as lonely as Patrick at his grade 12 prom. Being a bond short here.
So Daniel,
this doesn't actually mean that you want to go short bonds, by the way, but it just means there's a high probability that we're either at an intermediate sort of top or turn, or we're just about to correct for a material amount of time. And I'd only put it's a 70-80% sort of probability whenever you see these things triggered. And we just got one in gold, by the way, too. And so it's sort of like we've had this scramble for collateral in the last 6 months. And it doesn't matter what collateral you owned, whether it was precious metals or treasury type exposures. They both did interchangeably as good as each other, but we've just we've had these things starting to trigger, and that normally means sit up, pay attention. And we've also had surprisingly a lot of our other sort of money flow models are all sort of set up that we could get much more of a material correction in treasuries than people are realizing. So, maybe Kevin on a short-term basis.
Okay, so what I wanted to ask you then, though, how do you think this plays out? You chose the 30-year, so you went to the far part of the yield curve. Do you think that this could result in the steepening of the curve? Like, do you still think that the 2-year and the Fed funds rates could potentially go lower, but then we have yields just pop higher on the long end of the curve with a steepener? Is that how you would think that this could play out, or do you have a different view on how this
when we start talking about the yield curve, if you were to put a gun to my head, I'd imagine it's probably going to stay inverted or continue to just sort of flap around for quite a while. I think we're probably still 6 to 12, maybe even 18 months, I'm not sure, before a material steepening dynamic kicks in to the yield curve. Normally when you get those like aggressive sort of steepenings of the yield curve, that's almost, they're pretty much tantamount to domestic conditions that are like scrambles for collateral, confidence crashes. And, that's actually when the yield curve is really starting to, steepen in a reflexive way. That's usually when you need to be out of risk assets or confidence assets. And that's when you need to get worried about the equity market. But
it's
while
because
it's inverted, you actually don't need to, I would never say you don't need to worry about the equity market, but, while it's inverted, that sort of actually just means we've got an under appreciation of, the need for collateral in the system, and confidence is still, probably a little bit excess, but it's more of a trapped confidence in that people are starting to realize that the system has gone too far. They're trying to scramble more. It's harder to find funding. There's maturity mismatches that are all starting to, strain.
But to me, if the 30 years just gone too far, the moment we see that revert, unless the front of the curve sticks with it, then that should cause a steepener. Am I wrong? Like, if we see that reaction.
If you're talking about I'm talking about a steepener that it's kind of like tantamount to 2008 sort of steepening. Now, if you're talking about a trading horizon of, say, 3 months, or sure, you probably get a little bit of a bounce towards a steepening direction, maybe. I don't know. But I tend to not operate on a sub 3 month or a sub 6 month even time horizon. A lot of what my methodologies are more geared to a 6
macro
to 24 month time horizon.
Right. That makes sense.
Okay. Well, Daniel, it's been great having you on. Why don't you tell people where they can find you and learn more about your methodologies and what you do? And so why don't you give us your website and your Twitter handle?
Yeah, so our website is prerequisite.com.au, and we've got a lot of quarterly letters there. We tend to go into a lot of detail on a lot of different subjects. They're a good read if you want to try and get an understanding for how we look at the world and some of these different tools and methodologies we've evolved. And also, I'm sort of on Twitter. It's sort of sometimes I go through seasons and tend to do things on there, and other times I disappear. But Daniel J. Want is the Twitter handle. Okay. And you'll see me there occasionally.
Okay, great. Well, and for those who want to hear more from Daniel, make sure you stick around for the after hours where we're going to talk about what's happening down under and the black swans that are going through his lawn.
Sounds good.
So, Patrick, it's been a couple of weeks since we've gotten together and talked markets, and looks like we missed a couple of important weeks to take a vacation on.
You know what? I have learned now over the last, let's say, 5-6 years that it's actually a really bad idea to vacation in August. I think I'm going to start vacationing in July and always be trading in August. Like, I don't know. It's a long tradition to always take off the last 2 weeks of August, and it's stupid. It's just So
you know,
much
it's
happens.
interesting you say that. Scott from Volatility Wiz, I can't remember. You know, we're going to get him on the show. He actually messaged me about this very same thing. He said, "Why does everyone take the last couple of weeks of August off? Often it's the best ones to trade." And I said, "I don't know, but I'm too busy, you know, on vacation to think about it." And then.
Well, you know, it's good that we're back here for an update, man. But what's your thinking? Like,
Okay. I know you wanted to talk about stock market or the US dollar.
But how about the 10-year yield?
I think that's what we have to talk about. And first of all, I have to give a big kudos to you that I have been so wrong. It's not even funny. This the 10-year yield. Let's just think about this. In May, or when was it? Let's just look at the beginning of the year. The beginning of the year, it was 260.
We started off in October up at 3.25, let's say.
Yeah,
and,
okay, but
and
listen,
the start of the year was 275.
Right. I was never, like, I remember that was the Jeff Gundlach 2 closes below, past 3.25. And if you remember correctly, I was fading that and saying that, you know, even though I'm a bond bearer, I feel like that this is the stupidest thing in the world. You got to be going the other way. You got to be buying them here. But I then proceeded to turn bearish way, way, way too early. Like, just no doubt about it. And it's amazing to me that I saw a stat the other day that the government bond index had its best return since the great financial crash.
Wow.
Or crisis. I called it a crash, but it's probably a crisis. So now, let's just stop and think about this. The great financial crisis, the world was ending. You know, people were worried they weren't going to be able to be, you know, the banks were going to foreclose on their houses. That's if the banks were actually, people were worried that there would be no money in it. It was a disaster. Okay.
Right.
Let's think about what we've experienced today. Unemployment still kind of terrific. No real issues there.
3.7 or something.
Yeah. The stock market within 3-4% of the all-time highs.
Yeah.
And yet there is a complete and utter bubble in fear assets. It's shocking to me. It's actually
bonds went parabolic.
Yeah, and you know, good for the bond bulls. No doubt about it. You guys nailed it, and it's been a great trade.
The last leg, I was on the sideline.
But listen, that's Patrick,
all the big picture trading members and myself were selling the TLT around the 140 level. So
you know what? You still got a big, huge chunk of it, and the reality is, you're not an idiot like me trying to fight this thing. I though find it amusing that people aren't willing to call this a bubble.
Okay. Where I push back on you is that the rest of the world is in negative interest rates.
Oh, yeah. So first of all, I am calling it a global bond bubble.
Yeah. Okay. That I'll agree with.
Not a U.S. bubble, because relative, they're cheap. I get it. I understand why you'd want to buy it. I get it. Like, if central banks throughout the world continue to try to throw monetary solutions at every single slowdown, then the U.S. is going to zero, and it's going to be a great trade. So I completely buy that. But how people – listen, Patrick, 1 second.
Yeah.
You know that there's pension plans in Europe that are actually up 30% this year? Because they own these bonds. They're along the bonds.
Dude, the German 10-year hit minus 70. What is it?
Okay.
What was the low? Hold on. The low was minus
74.
What? Holy
cow. So let's just stop and think about what a bubble is. A bubble is buying an asset that you know can't make any money with the hopes of selling it to somebody else, like greater fool. At even a higher price.
Yeah.
By its very definition, bonds at these stupid negative rates are a bubble. Yes. There's no way you're going to make money in this bond market unless you sell it to somebody you sell it as it goes even more negative in terms of rates.
That is, of course, unless that's because you delusionally continue to believe in free markets and that there's real, risk management decisions being made here. I mean, when you go back to my financial repression narrative, it's just a massive suppression of interest rates that's being manipulated. It's not free markets.
Listen, I'm not disagreeing with you. I understand why.
But then, how could it be a bubble then?
Because not only listen, Patrick, I'm going to push back on this. It is a complete bubble. Everyone on Twitter is long out the hoop. It is one of the most crowded, crazy trades that I've ever seen. It reflects the mania of kind of the .com bubble, in my opinion.
Right.
And listen, it's working. It's you guys have great. It's continued to work. It's a great trade. Everyone that's bought bonds is up all sorts of money. Great, good for them. I've been wrong. I'm not going to deny it. But I will say the fact that everyone is telling me what an idiot I am and how this is such a great trade and how it's only going lower, and that's the very definition of a bubble, because people think that somehow that if that the bubbles are created and that the majority of the people are going to see them. And I call bullshit on that. Everyone seems to think, oh, you know what? The real estate bubble was so easy to see. The .com bubble was so easy to see. Bullshit. No, really, honestly, I was in both of those, and everybody was long. Not now. Obviously, you're going to give me some examples. You're going to give me Kyle Bass was short, Paulson was short, or there was some guys in the thing. But the reality is that those were the exceptions, and the reasons we know about them now is because they made so much money going against the crowd. But if it was easy to be on the other side of those trades, then why didn't everyone do it?
Yeah.
If it was such an easy, and if it wasn't a bubble, then why didn't everyone do it? And I contend that we are in the midst of the greatest, the third bubble of my lifetime, which is the sovereign debt bubble. And I think that negative rates are by its very definition insanity, and the fact that we can't see that the Germans and all of Europe rushing out to buy U.S. bonds is creating this environment of this bubble. Was
it Raul, Paul, that was showing his little graph where he was talking about -4?
Yeah. So I would, my new line
we have to talk to him about this, don't we?
Well, yeah. Well, we should talk to Raul about this, but he's there are bond bulls and then there are rules, because he is just in another, I've now kind of prefaced it as saying that guy is Raul Paul bond bullish, because that's how he's just in another league. And listen, good for him, man. He's been bullish this whole time and he's been making a ton of money. And I'm not trying to. I
liked his original call where he was saying we're going down to 50 basis points on the 10-year. But the idea of seeing -4% on some of these Europeans, it's like.
No, he said -4 on the U.S.
What?
Yeah, that was one of his latest tweets. He went.
Was
and
it
put
the
U.S.
one?
Yeah, no. He recently he just did one of these. Anyways.
Yeah.
Doesn't matter.
I will take. We should find out, because it's going to be interesting.
I just think that we're going to look back at this time and we are going to laugh that we thought we couldn't make inflation. I really think, you know what, this is immortalized. You know what, for those who are listening, they can go dig this up in 2025 or whatever and go, look. You were an idiot. 1.5% on the 10-year was a great buy because it's -4 now. And then you can play it for me in 2025. But if I'm wrong, I'm wrong. But I look from a risk-reward perspective. This is one of the most crowded trades and one of the most lopsided trades I've ever seen.
So one thing that we've been doing podcasts together for on and off between different things for a couple of years, and I've gotten to know you pretty well. The one thing I can tell you about you is that you just cannot, when you're in a bubble, the most valuable thing is to ride the bubble and just know when to get off the train.
Oh, completely. Listen, George Soros said that. He said Yeah,
you can't ride a bubble. You're like the ultimate contrarian.
I completely agree.
The moment everyone likes something, you hate it. And I think what you need to do is just relax a little bit and say, I'm going to go for a little ride. If these guys want to take this market a little farther, I'll clip something out of it. Like you seem to like be obsessed with just calling everyone crazy.
Oh no, I'm not calling you crazy.
Oh, you're calling everyone crazy.
No, I'm saying that we're in a bubble.
bonds.
I'm saying we're in a bubble, and then I think the risk reward. Now, Patrick, I will talk to you about what I think is super interesting about this market.
All right, tell me.
If you go look at who's long and who's short,
Right.
there's very few people that'll come out and say I'm short bonds. Like apart from like I'm an idiot, and I'll admit that right now I'm short, and I've been like taking stabs at it, and I get like roasted on Twitter all the time about it. But the reality is I'll admit it. But most people won't admit it. Most people won't say it's a bubble, right? Like most people are too scared to say it's a bubble. Yeah. I'm going to say it's a bubble. I think it's got all the bubble characteristics. I think that it's by the fact that we're negative and we're not calling it a bubble is crazy. But anyways, but I look at who's short, and I look at I kind of look at the big accounts. PIMCO is actually underperformed by like 300-400 basis points in their big account. So what that means is they're short.
Or they just shorten their duration.
So they're short their duration, but the reality is that for all intents and purposes, that's behaving like a short to them because they're underperforming their peers by their benchmark. So they might as well be short because the pain there is huge. Okay.
Yeah.
Then who else had a bad kind of year to date? I'll give you a hint. He was recently at the Burning Man.
Dalio?
Yeah. Bridgewater's down 6 or 7% this year.
Really?
So I ask you, like with the stock
I think he's just going too much Burning Man.
Yeah, he burned a little too much at the Burning Man. But the reality is that they also, and to think about it, stock market's up. How are they actually down on the day? They got to be net short bonds.
Yeah, probably.
Right? So they're down.
But I mean, aren't they doing like one of their all-weather strategies, or do they have like a... No,
but Patrick, they're down 6%. What's the stock market on this year to date? It's up.
It's up, yeah.
Gold's up. Bonds. So the only
the only way is that they were short bonds.
Yeah.
That's fair enough.
Okay,
yeah.
so that's it. Then you go.
But they weren't they like short European equity as well?
Yeah, but they might have been, but Patrick, I'm pretty sure they're short bonds. But anyways, the next thing, Guggenheim, big firm. That guy, Scott Minerd's basically been talking about he's short as well, whether he's outright short or just like leaning. So I look at it and I think this is kind of a very interesting setup. We have retail, fast money, hedge fund managers, everybody out the wazoo long. The big, huge long-term money is short. Now, maybe you'll say,
squeezed.
Yeah, maybe you're going to say, okay, PIMCO's not going to be able to stand the pain. They're going to cover it. Maybe Bridgewater's going to cover it. I don't know. I'm on the other side. I think there's a disaster.
Of course you're on the other side. Of course you're on the other side, dude.
I'd rather be with...
Our listeners would be disappointed if you said anything different. You realize
that's right. That's right. I think even though Ray Dalio is experimenting with all sorts of hallucinogenic drugs at Burning Man. No, I'm just kidding. He's not. I don't know if he is or not. If anyone was there and can confirm that or not. Or maybe there's another tent I've heard about.
Ray, if you're listening, what? I've never been.
Ray is not listening. Don't even kid yourself. Don't even joke. Do you know that there's another? Have you ever been to Burning Man?
Never.
No, I'm pretty sure. No, I haven't, but I've heard stories. I'm pretty sure there's a tent to where you might. It's like a key party. Let's just say it's like that. So maybe he's just he's got to spice things up a little bit, and he's gone to that tent. Anyways, regardless, I look at it. I would rather be on PIMCO, Ray Dalio, and Scott Minerd's. I don't know how to say his last name. I'd rather be on his side of the trade than all of these guys that are reaching for the bonds, telling me that it's going to go to zero and that they're going to the Fed's going to peg the curve.
So you've only talked government. What if what do you think will happen to things like investment grade corps in the U.S.?
I think they're fine. I think that the
What?
spreads might wide. No, like
just
no spread versus the governments.
not spread. Forget it. I'm talking about look at the run on this chart.
Ah, yeah, but
Like,
it doesn't
they
matter.
have
Like,
been-
so if
But I
spreads
mean,
stay
look,
the same,
so-
but if the
so-
spreads
so
stay
if
the
the-
same, Patrick, then I just don't think it matters. Whether you're short, if spreads stay constant, it doesn't matter if you're short investment grades or if you're short governments. It's going to be the same trade. It only matters if spreads change. And all I'm saying is I don't really have a view on spreads. And in
Right.
fact, if I had to guess, I would probably guess that maybe spreads even might tighten going forward.
Tighten.
Even that sounds stupid, I know, but like
Yeah,
I
but
just
I mean,
think
I'm
I think there's a
surprised.
lot
I-
of fear. I think there's a lot of fear in the market right now. And
See, I wouldn't
suspect
have
that-
I wouldn't have the kahunas to say that. Like I look, you know what? I think that they could stay flat, but for them to narrow is a different call.
Yeah, listen, I'm not trying to say that I go out long like credit spreads. I would never do that trade. I'm just saying that if all else being equal, if we get a situation where the market actually goes into a real sell-off, I could see a situation where corporates do a little bit better. It is interesting that the amount of supply that came on Monday when we got back, or Tuesday when we got back after Labor Day from the investment grade credits is huge.
Right.
Like there was like 29 issues or $29 billion of issues. I can't remember, but it was a big number. But it was like across the board, a lot of different sellers. Apple doing a 30-year. I like their style because they're going out and selling the long end of the curve.
Right.
It makes a lot of sense, and I think that's just going to continue. The only thing I would caution you is that money, although I would love it to go into the real economy, I don't see that happening. That's not going to go to CapEx. That's going to go to more financial engineering. That means more buybacks.
Yeah, well, we'll see. You have anything to add in this segment? Or are you spent? Because this was the Kevin Muir rant session.
It was a little bit.
Are
of
you
Kevin
done?
Muir
Are you
rant.
are you
well, how
are
about
you
this?
done ranting?
Why don't you tell me what you think's going to happen, Patrick?
Well, I'm not short bond. Well, actually, I'm short corporates, but I'm not, and I'm flat on treasuries, and I certainly subscribe to the view that there's room for the S&P to give the shorts a little bit of a squeeze. But I don't think I've changed my views too much from the bigger picture of the other things that I'm looking at. So, I mean, we cover
Still
those
think
things.
that you're in the Raoul Paul. You're a Raoul Paul bond bull, just not right now.
Well, you know what? I just believe that that the catalyst for like an inflationary catalyst, like you believe will happen, the risk of it eventually happening over time is there. I just think you're way too early, and I don't think that that inflation monster is an immediate fear. But maybe I'll be wrong. Maybe,
Okay.
and
So here,
that'll be-
Patrick, I have a question for you. Do they do one last squeeze of the shorts to really make me doubt myself?
on the
Do
bonds.
they? Yeah. Do they
Oh, it's
push
for-
it
it's-
one?
The market is very capable of that. There's
for sure.
there's no
Yeah.
topping formation yet that you can confirm, which basically means one more squeeze higher is 100% on the table. Like I'm not saying it will happen, but you certainly can't rule it out anymore. There's not like a topping formation that is already reversed, right?
Right.
And therefore,
one
it's
thing
on the
I will
table.
tell you and warn people about is if we do get a situation where we get this massive run higher from here, you have to remember that increased volatility is often the sign of a top, not a bottom. Not of a continuation.
Okay.
So I'm prepared for, another move down into new highs.
Right.
That seems to suck everybody in, and then that's the prairie dog that you got to sell.
Right. Right.
Noble
All right.
animal.
Noble animal. All right. Let's go on. So, Kev, we normally do a tail here, but we're going to save that. We're going to jump right to this week in trading history. And so I wanted to do, I was torn between doing two different segments, right? We're going to talk a long-term capital in just a moment. But the other this day in history kind of story that was really interesting was the establishing of the U.S. Treasury Department back in 1789 in the U.S. happened on September 2nd. and that's 1789. But what's interesting is Alexander Hamilton was named the first Secretary of the Treasury, and it was William Duer that was became the first Assistant Secretary. But the funny part of that story, why I had to mention it, is that William Duer got basically got caught in a very speculative position, ended up actually blowing himself up, and spent the rest of his life in debtor's prison.
Nice.
So the first Assistant Secretary of the Treasury of the United States spent his days in debtor's prison. I thought that was anyway.
That is interesting. I have 1 second before we go on to the next topic. I have one question for you.
Tell me.
Do you think Mrs. Mnuchin would stay with good old
No, absolutely
Mr.
not.
Mnuchin if he was in debtor's prison?
Well, it actually depends, because if she was riding his wallet while he's in prison, then what?
Patrick, I'm shocked that you don't think that she's with him for his sparkling personality. Okay, let's go on to the next.
All right. So anyway, this week in trading history, what we did want to really feature is long-term capital management. And it was on September 2nd of 1998, just over 21 years ago, that John Merriweather, head of the long-term capital, sent out that letter to investors saying that the fund has lost $2.5 billion, or half of its value that year.
It's just a flesh wound.
Just a flesh wound, 52%. Yeah, we'll fight another day. And yeah, that was the story. For those of our listeners that don't are listening to the podcast and don't see the picture, like Kev, you did a really funny macro tourist picture here. Why don't you tell everyone?
Oh, because it was there's a great picture that I dug out. It was the picture of the long-term capital senior staff huddled around these huge CRT monitors, looking very intent and looking at their positions. And I put a little headline in there. It says, okay, so we're short the 30-year swap spreads, short S&P 500 index vol, long risk arb spreads, and stuffed to the gills with emerging market debt. We're in good shape.
The original VIX sellers, right?
That's right. And I missed the part, the original VIX sellers, because optionseller.com had nothing on these guys.
Oh, nothing on them. Like, what a story, right? Because it was actually the first too big to fail scenario that happened. Was there one before that?
Well, no, they let them fail, but they definitely had the first one that they were worried about an individual firm pulling down the whole system.
Right.
And one of the real problems was the fact that there was a lot of copycats out there. So it wasn't just long-term capital, but also Goldman Sachs, and I think even Lehman had some, and I don't know if Bear Stearns had some, but there was definitely a lot of copycat traders with all the same positions. And actually, that was one of Merriweather's big complaints, was that as these guys were trying to save them, they were merely front-running their positions.
Okay. Yeah, that would make sense, right? But ultimately, they got zeroed. But what was interesting, so there was that book written, and so those of our millennials that weren't around or following the markets when this happened, there's a great book written on this, right? When Genius Failed. Yeah,
and that's the thing. This firm was, for those who aren't familiar with it, was supposed to be the smartest and the brightest of all. Like it had Nobel laureates. It had the original. John Merriweather. For those who don't know, that he was the character in Liar's Poker that challenged Goodfriend to the game of Liar's Poker. And he's legendary in terms of his ARB group, and Salomon Brothers made more money than I think the rest of the firm some years. Yeah. So it was these are just iconic figures. And this when he went out to make his own firm, and one of the reasons he went out to make his own firm was because it was actually in the aftermath of the bond rigging scandal from Salomon Brothers, where another trader had gone and put in orders for too much. On every Fed, what is it? Actually, it's not the Fed; it's the Treasury auctions for the bonds. He had overstated the pro account, the firm's account, and in doing so, had broken all sorts of rules. And then Salomon Brothers got their hands cuffed and are tied because of the regulations. And then Merriweather decided he was going to go out and start his own firm, which was Long-Term Capital Management.
And then there's Myron Scholes, right?
Myron Scholes, the Black and Scholes option theorist. And there's all these really, really smart guys. And so I actually was laughing when I was reading through. And when they started, in 1994, they had 30 traders they hired right off the bat, Patrick. And my favorite stat is that $10 million they spent in SunSpark servers. You probably don't even know what a SunSpark server is. But on the desk back in like even I used SunSpark servers as well. I remember that we had one that cost $50,000, and back in the 90s, $50,000 was a lot of money. And think about that, $50,000 on a computer that would just be sitting on your desk. And these were Unix-based systems, and they were a lot better than Windows, because back then Windows was shit, and you just couldn't rely on it. No, you couldn't. It was the blue screen of death, and there was no way you could go do any serious math or rely on it for any sort of trading. So all the really big, kind of really important guys would go buy these SunSpark servers, but $10 million. That's like everyone had one, it seems like. That seems like a crazy number to spend.
Well,
yeah.
That's crazy.
They ended up zeroing themselves, though, because they put on
we're going to
these...
talk about that, right? Like, we're going to save that for our
right. But
tales,
you know, let's talk about what they were doing. And I kind of laughed about it on my little meme there, the picture that I created. But a lot of the trades that they really hurt them, although a lot of people focus on the Russian default being the trigger that caused the spiral set in motion, it was really, I think, if I can't remember exactly, but I think it was the swap spreads that really hurt them the worst. And what's interesting is the swap spread is nothing more than the difference between bank funding and government government funding. And I think they were trading at I don't know. I think they were like 40 or 50 and basis points, and they thought they should go to zero. So they were short the swap spread in big time. And the thing about it is that this was a very illiquid instrument, and I think it's what happens is in the summer, you know, everyone goes away, and then next thing you know, people are moving stuff around, and it starts getting marked against you, which I think is part of the reason of what happened recently this summer with bonds. A lot of the things just started going, and that was it. But anyways, back to the swap spreads. We go look, and they blew out, and they had been trading at 40 basis points on the 10-year. During the long-term capital management thing, they blew out to 98.
Wow.
And then eventually they went even wider at 140. And for the longest time, it's actually really interesting because swap spreads theoretically should widen in a crisis. And that is initially what happened during the problems in the great financial crisis. We saw, swap spreads move from 40 all the way up to 80 during the financial crisis. But what's interesting is after that, and in the ensuing months after the great financial crisis, they actually went negative. And swap spreads should never go negative because you should never have a situation where bank credit is trading lower than government credit. Because the government always should have less, there should be more of a risk from bank credit. And so it just kind of illustrates the crazy stuff that these guys were trading and the fact that it really doesn't have that much to do with reality. And it had more
theory
to do with
versus
flows.
reality. When you have PhDs, they have theories.
Right.
And reality is that there's a counterparty to every one of your trades. And in the end, when you trade as big as they were, those counterparties are huge. And the thing is that you're not going to have natural price discovery because the participants are all wound into these massive positions on either side, and they're not going to let up.
Yeah, they've been all well. That is true as well. And there's some game theory about that occurred because people realized they were offside. But I guess the point is that they were trading in very kind of esoteric positions that really although there was great theories of why they should work, the reality is that they weren't quite as smart as they all thought they were, and they had leveraged these positions like to the moon.
Right.
Like, think about it. They were bond guys that had decided to short S&P vol. And listen, I get it. I understand why they're short S&P vol. S&P vol generally trades higher than realized vol. So on the whole, if you can position yourself correctly and do it over time, you are better off being short. But the thing is, you have to be able to stomach the pain on those spikes,
Right.
and they just hadn't thought about that. And the real lesson during the long-term capital was that, and I think this was the first time it really had happened to this extent. In times of crisis, all correlations go to 1 or negative 1. And that was basically it. And that was the real problem. You wouldn't they were complaining that there's something, one of their other trades they did was an off the run versus on the run bond. And on the run bonds are the ones that are the latest auction, and they're the ones that everybody trades. And then there's an off the run, which is the previous auction or some other one like that. And those two might have a spread of like 10 basis points or something. And you buy the one and short the other, thinking that 10 basis points will eventually normalize. That trade, in times of stress, all of a sudden went to 40 or 50 or 100 basis points, depending on the maturity. And there was no reason for it. But markets can get way more illogical than they ever imagined. And that's the true lesson from long-term capital.
Hence why there could still be one more squeeze in the bond market, but we won't go there.
Exactly. Well, I haven't puked yet. That's why
there's one more.
There's one more squeeze coming because I haven't puked yet.
Now we're not done with long-term capital. We're done with this segment, but let's move on because tales from the trading desk. But we're going to continue down the path of long-term capital, aren't we?
Right. So I'm going to read something from When Genius Failed because it's one of my favorite stories of all time. And it's going to be from this book from, what's the author's, Lowenstein, I believe, is the fellow's name. But anyways, let me just go. It's going to be just a couple paragraphs. Bear with me. So he says, badly in need of a lift, Merriweather called an old friend, Vinnie Matone, who had been the fund's first contact at Bear Stearns. Matone, who had retired, was everything that JM's, and that's John Merriweather's, elegant professors were not. He wore a gold chain and a pinky ring. And he showed up at long term in an all-black silk shirt opened at the chest. He looked as if he weighed 300 pounds. It's much like Patrick's look. Unlike JM's strangely wooden partners, Matone saw the markets as exquisitely human institutions, inherently volatile, ever fallible. Where are you? Matone asked bluntly. We're down by half, Merriweather said. You're finished, Matone replied, as if this conclusion needed no explanation. For the first time, Merriweather sounded worried. What are you talking about? We still have $2 billion. We have half. We have Soros. Matone smiled sadly. When you're down by half, people figure you can go all the way. They're going to push the market against you. They're not going to roll, which means refinance your trades. You're finished. And I just love that story, Patrick. I think it's so true because at that point, it no longer meant anything about the theoretical value of these contracts or anything else. It was purely gamesmanship of, sharks in the water smelling blood, and they were going to circle it and finish those guys off.
Like those people that are short bonds today, right?
Yeah.
Why don't you give optionsellers.com a quick call and ask them how that worked out with some nat gas contracts. Dude, you know what? It's amazing how the market does that, but people just have to remember that that you can go with the theoretical and fundamental values of things all you want, but ultimately the markets are a behavioral exercise of traders trading against other traders, investors against other investors, and it's how you're positioned and who's got the upper hand, right?
Especially in the short run. Especially in the short run, or short to medium.
Sure. Well, no, over the long term, fundamentals matter, but you have to have the staying power. You have to. You can't get shaken from your position. And this is exactly what your story's about. Is that once he said you've been halved, he said you're done. Right. Like you need to have positioned yourself in a way that you couldn't get halved.
Exactly. You're absolutely right. So.
Right.
Anyways, that's it. Good tales from the trading desk. We're gonna Lowenstein. That one's from him, and I love it. It's one of my favorite stories of all time.
And listen, for all of our millennial listeners that did not yet get around to picking up that book, it's a little older, but man, is it a good one.
It is a good one.
Definitely do that. So, Kev, time for the WTF clip of the week. Set us up. What do we got?
Well, it harkens back to that age. In the 90s, we had Caddyshack, although I think Caddyshack was in the 80s. If you sat on a trading desk in the 90s and wasn't able to kind of quote all the different Caddyshack lines, then you weren't doing very well, because it was something that was very important to most traders. And I saw Sam Zell talking about how they were the economy was in better shape and that the recession wasn't as close as he thought. And I thought, you know what? This reminds me of somebody else that thought that things were looking good, and that's the priest from Caddyshack. So I decided to do a little mashup. So let's play the tape.
All right, let's watch.
I think that I have been looking for a recession for some time. And every time I get a signal that it's likely, I get a reversal.
Did you see that? Miracle, eh?
Nice shot, Bishop.
Which I've never had that experience.
What kind of signals does a guy like you look for?
Well, I mean, we have a company called Annixter. Annixter is an $8 billion worldwide distributor of wire and cable.
Yeah.
I've owned the company for 30 years. It's always been a sign when customers start delaying orders that we're about to head into a recession. 6 months ago, they started delaying orders. And I said, well, here we go.
Right.
I could break the clock record, theoretically.
Better come in until this blows over.
And then 3 months ago, they reversed.
Back up again.
Yep.
So what else? Other interesting recession signals that you can share with us?
You know, I mean, prior to the Great Recession was the first time since World War II that we went into a recession when real estate was not in oversupply. We are now in another situation where real estate is not in oversupply.
Now?
And if real estate is not in oversupply, can you have a recession?
So where are you now? Then we're not having a recession.
I don't think so. And I think we're going to get through the election, despite, the headlines. And so I think that the overall economy is in better shape than conventional wisdom.
Well, what do you think, son? I keep playing. I don't think the heavy stuff's going to come down for quite a while. You're right. Anyway, the good Lord would never disrupt the best game of my life. I'm infallible, young fella.
Oh man, what an epic scene that was.
Yeah. It's in good shape. I don't think the hard stuff's going to come down for a while yet. And you know what's funny, Patrick? Actually, one of the reasons that I like to bring this one up is that during the long-term capital management, I was actually trading on the desk, and I was running the derivative book, and I was getting crushed. And I remember at one point I was short volatility, and it got so bad that we decided that we weren't going to hedge our gamma anymore. Like, we weren't going to hedge our delta down there, and we just turned off the machines. We thought to ourselves, it's either going to go no bid and we're going to be screwed and it's not going to matter, or it's going to bounce. So we just kind of turned off our machines and stopped trading because there was no liquidity. And I remember my boss, who was a bit of a character, and he's always a really good guy. And he came and he saw that I was having a tough day, and he knew that things were tough, and he kind of grabbed my shoulders and started squeezing. And he says, "Don't worry, I don't think the hard stuff's going to come down for a while yet. You should be okay." And for the longest time, when everyone was having a tough day, I would always kind of say that line because I think it's really funny.
All right. Well, that was really funny, and thanks for sharing that. So let's move on though. Kev, we're getting to what my favorite segment is talking about not only the top 5 things to watch next week, but also what happened last week. But our top 5 from last week is not from last week, is it?
It's like 3 weeks ago.
From like 3 weeks ago.
Okay, let's see what we said.
Exactly. This is going to be a true testament. We're going to find out because I didn't even actually rehearse these. Let's see. All right. So number 5, Home Depot earnings.
Oh,
so
God.
actually, that was pretty hot, and Home Depot's been ripping. That's.
I can't remember what I said, but I was probably bullish because I'm always bullish on home builders.
You were, and I thought it was actually going to be important for the home builders to see whether or not Home Depot. But what a breakout! Like, I mean, this is actually running really strong for this market.
Patrick, this bond bull move, although I think it's insane, is the greatest thing that's ever happened to U.S. home builders. It is.
Sure.
It is a huge tailwind at their back.
Right.
And you laughed at me when I said that the U.S. home builders were going to be the best performing sector.
Oh my God! So then you were a closet bond bull, because in order for your home builder trade to work, you're a closet bond bull. I'm bearish on bonds, but when I'm wrong on my bond trade, and my home builders are going to make all my money back, right? Is that
Gotta
what you're
be hedged, baby? Okay, let's go on to number 4.
Let's drop this topic, right? The euro did break down.
Kudos to you. You know, that's yours. You've been harking on that and saying how terrible it is, and I've been trying to defend it, and it just disappoints.
You know what? It's amazing because we've had actually a couple of really strong days in a couple of other currencies, Canadian dollar included, where they've been bouncing, even the pound, all these different things. We'll talk about the pound in a bit, but the euro still looks like shit.
It looks like death. The Grim Reaper.
One day up, and that's it. And this is nothing to write home about yet. Euro weakness is still there. You know what? I'm not going to go look up what those flash PMIs. They were weak though, weren't they?
I think they did. I think they were shit the bed week, if I remember right. That's 3 weeks ago. That was at the start of the kind of scare about the economy rolling over.
Yeah.
HSBC number 2. HSBC and the banks exposed to Hong Kong.
They were down quite a bit, but there was a little bit of a gap. Obviously, when things kind of calmed down over there, right? Things de-escalated a little bit, and you see a nice little gap. But I mean, they did go lower after we made that call.
For sure. I suspect you were bearish. You're always bearish, so I don't remember what I said. But
I'm just excited to cash in on Deutsche Bank at 5 when
oh
we
my
cash
God.
in that bet.
So listen, you know what? What did we bet on that? Because if we didn't bet a steak dinner, I'm willing to double it up into a steak dinner.
Okay, hold on. I'll check what we bet.
Because I love it. I think that if that's the worst that they can do, I love it.
Oh my God, you are.
I get it. Whatever. Just
no.
It
was a steak dinner. Steak dinner. 10 or 5 first, and was done. We did that bet on July 2nd.
Okay,
and
that's fine.
Which one's first, 10 or 5 on U.S. dollars?
Yeah. Good. I'm glad. I'm like, I love it. I love the bet.
Oh my God. You know what? I'm going to enjoy that steak like you won't even believe. Because you're so goddamn cocky about it.
No, I'm not. I'm just saying that I want to double it up into the steak dinner. That's all I'm saying. I'm not saying I'm going to be right. I could lose. I get things wrong all the time.
Oh, there's the humility.
Number 1,
there's
Jackson
the humility.
Hole. Jackson Hole. Wasn't Jackson Hole the time that then he said something, but then the Chinese basically came out and said put into place their extra tariffs and making it a lot worse?
Well, everyone was. Everyone. Kevin was talking about the idea that they could come out there with a very dovish statement or something.
No, he was relatively dovish. He didn't do anything. He stayed in line.
No, they still did the mid-cycle shit. He didn't deviate from what he did in the earlier Fed meeting.
Oh well. Anyways, all I remember is that
you're saying that he deviated from that?
Anyway. No, I'm not. I'm not trying to say that. I'm saying that it was fairly in line. There wasn't really anything.
Yeah.
And not only that,
the news was China and Trump.
It just kind of quickly got overwhelmed with the China news.
Yeah.
Okay, let's go to the top 5 things to watch.
Top 5 things. So number 5, we got to talk nat gas, buddy. Like I see for me, the technical level, I use a little bit of those Fibonacci's. But to me, the kind of I'm rounding it to the 230 level was actually an important level for nat gas to beat. And, we're going into we have had a lot of, from a seasonality perspective, a lot of runs in that kind of October, November, December window for nat gas, especially going into those January contracts. It tends to be a little bit of a run. The question is, are we about to have a seasonal deja vu? What's your intuition?
I think that's often a hurricane run, right?
Yeah.
And so the question is, does this hurricane affect it, and how much of it is the kind of anticipation of this being a problem? And I'm not really sure. I don't know, except that longer term, when nat gas is hitting 220, I know all the reasons why you should be bearish, but I can't help myself again, Patrick. I'm a contrarian.
Oh my God.
I think you got to buy some of this stuff down here.
Oh, buy. Okay, it's okay. No. That's okay. Then that's not. Oh yeah, I guess it's a contrarian. It's been a downtrend
for sure. No, it's you know what? Like it was just a month ago that we were hitting all-time lows or whatever.
This is
not
interesting.
But
you know what's interesting is that the natural gas stocks really have just not responded, and I think that's because they're basketed into those energy ETFs, and you need a whole turnaround in the space for those nat gas stocks to kind of march to the beat of the whole. Like I don't know, like Chesapeake and Gulfport and Canada, none of these have reacted in any big way.
For sure. Well, but let's face it, nat gas has pulled itself off the mat a little. It's not really doing anything yet.
Yeah, technicians will like to observe the break of that descending trend line, right? I mean, it's come to life. It's come to life, and it's interesting. Like the way I would look at it is that what the real test of whether it's a bull market or not, or the beginning of something, is not the breakout, but the way it behaves in the pullback. If we see, let's say, throw 10 cents back, and it's being supported and bought and accumulated, and it holds the line very well, then that's when I would get really bullish. Like it's never the main breakout; it's the way it behaves in the pullback. Could you agree with that?
I like that. That's some dark magic I can get behind. Okay, let's go.
Right.
Next one.
All right. So the next one we got here, number 4, healthcare. I picked this one.
Yeah, you did. That's one's yours.
This one's mine. And really, what it comes down to, and what I wanted to really observe here is like it's been such a mixed bag in the healthcare space. I mean, the Pfizers and the Johnson and Johnsons and United Health have all just been hammered. But then you've got the Mercs that are trading at pretty much 52-week new highs. So it's kind of like a bipolar kind of grouping in the sector. And what's interesting is that I've always at least viewed the healthcare to be a defensive space, but yet the staples and utilities have been running, and healthcare has not in any way participated in that. Do you have a different view about the healthcare space, or do you consider it relatively defensive?
I don't know. You said bipolar. I'm still thinking about this girl I dated once.
But anyway, so the point.
She told me she was bi. I didn't know she meant polar.
All right, but listen. I am not trying to make a bull call on healthcare. All I know is that a lot of those stocks have just been killed. And maybe, just maybe, there could be a little bit of life here. I just want to watch it. The whole point of top 5 things to watch is to watch something. And I'm watching healthcare. I want to see whether or not the bulls can muster up something here, or whether I'm watching nothing. Well, I don't know.
Sounds good.
What's your any opinion?
I don't have any insights into that. I'm going to leave that magic up to you.
Right,
number 3, the ECB monetary policy statement. I don't know, these jokers. It's like Gordon Gekko said, if they owned a funeral parlor, nobody would die. These guys are just they're such idiots. I can't even tell you. If they come out and actually try to do more monetary stimulus with lower rates, it's just going to be a disaster. I saw that this week, maybe it was this week it was this week, the Deutsche Bank president or CEO came out and said, rightfully so, nobody is going to go out, and none of my corporations and my clients are going to borrow more money if you make it from minus 50 basis points to minus 60 basis points. You're doing absolutely nothing, and in fact, you're hurting your economy by continuing with negative rates and by making them more and more negative.
Yeah.
So the quicker these idiots just realize this and stop trying to fix their problem with this insane policy, the better off we're going to be.
Right.
So
well, you know what? Let's watch and see. We can comment on it next week when we find out what they did. So
Listen, I'll tell you one thing. I could see a situation where if they actually lowered rates, that the European stocks go down. I think it's gotten that bad that monetary stimulus in Europe is actually going to cause risk off. That's how bad I think it's become, and I think and the markets realized how stupid a policy it is. The central bankers and the academics just haven't realized it yet.
All right. Number 2, Kev.
Retail sales and CPI. Well, I'm sure you're thinking they're going to be weak, and you're thinking that CPI is going to be 0 because there's no inflation.
Well, I don't need it to be 0. I just need it to be below 1.9 so I can cash in this year.
Oh, yeah. Okay, here, I'm going to go out on a limb. I'm going to go out on a limb. They're both going to be better than expected.
Okay, I'm not going to say they're going to be worse than expected, but I'll take it that they're not going to be better. I'll take the flat.
Okay, fair enough.
I'll take the flat. I think they're gonna. I don't think there's gonna be a big story here, but well, you know what? It might surprise. We'll see. Yeah. I mean, Trump is certainly hoping it stays hot. But anyway, we'll leave it at that.
Anyways, yeah, let's not get into Trump.
Yeah.
Number one,
though.
Here we go.
Here we go. Man, that was a surprise to me. What a gong show, isn't it?
It's not a surprise to me.
That
the pound
mutiny
bottomed?
No, I'm talking about the political.
I don't care about what actually happened. I care about the price action.
Oh, and because
that's all that matters.
No,
that's all that matters. Because I contended that it was the worst was in on the stock. It was all, I mean, not the stock, the currency. It's all priced in. They have terrible. Now I know everyone's going to tell me the reason it rallied was because it looks like Brexit is delayed for a little bit. Whatever. I still think that this is largely priced into the pound. The surprises are all going to be the upside, and I think this is a perfect example. One of my favorite trades right now: short euro pounds.
You know what? It's funny that we have a Deutsche Bank bet going because we have another bet going on this very topic, don't we?
Really?
We have a burger bet that we made on August 2nd. It was with Jared Dillian was on the show. We bet whether the pound's going 129 or 115 first for a burger.
Oh yeah. Well, that's going to be a good burger.
Oh, it's going to be when I cash in, it's going to be a delicious burger. That's
129. Like we're going to be there like within a week. I'm just kidding. I'm obviously not an idiot. I just play one on this show.
But listen.
Okay.
Listen, let me tell you one thing though. All right? If the political condition supports things being kicked down the road, there's a technical double bottom developing right at this 120 level, right from that Brexit 2016 low. And well, you know what? Maybe, just maybe, you might be right if this holds. Like, I mean, look, I'm going to stand by my bet. I don't see any reason why I should cover and beg you for for you to let me out of this trade. I'll be happy to buy you a burger because I still think it's going to go lower. But I mean, look at that. That's a major support line. I mean, if you're ever going to have a turn point, this could be it, right?
Well, I'm with you, bud. I think it's awesome. I love it.
Well, you know what? Like, yeah, because like we were talking, like, or we were talking with Daniel there. I mean, hey, guess what? Like, you could use the pound as your little reserve currency, right? Like, I mean, it's a safe haven for you.
Yeah, I don't think that's it, Patrick. I think it's
Well, come
cheap.
on, it's going higher. So I mean,
No,
why
but
wouldn't you?
It's going higher because it's so cheap. It's so down and out.
Right. So it's your little safe haven.
I don't think it's a safe haven. I
Oh
think
my
it's going-
God.
I don't think that's why it's going up. It's just cheap. It's a cheap asset. Things aren't as bad as everybody thinks it is. It's again.
Oh, the ultimate contrarian. The ultimate contrarian.
The fear that's from this is is built into this thing.
You know what? Your cockiness makes me very confident in
I'm not cocky. I'm just saying.
Oh, you are so cocky, dude. You know what? I am so happy to be on the other side of this bet right now.
Okay, sounds
I'm
good.
loving it. Loving it.
I'm going to buy you a Burger King or whatever. Who's loving it? No, that's McDonald's. McDonald's. You're getting a McDonald's burger from that.
All right. So, Kev, why don't you give us a parting word of wisdom?
Okay, this is from Warren Buffet there. He says, wide diversification is only required when investors do not understand what they are doing, which is why Patrick has like 40 or 50 stocks in his portfolio.
Absolutely. And I'm diversified in Argentinian pesos.
So I think that wasn't he also, maybe it was whether it was him or whether it was Munger that said something about you put your eggs in one or two a few baskets and watch them carefully. Was that?
They might have said that.
I don't know. I might be mixing up my Marco Wizards here, but there's no doubt about it that some of the more bold investors out there believe that if you have a portfolio that's too large, you can never really outperform because
you can't. Diversification dilutes any chance of you making any real money. So what you have to do is, at some point you have to make a bit of a stand, but you have to do it in a logical way, and you have to have a risk management plan on how you do it. It's not like we're not trying to condone everyone just put everything into one asset, right? But you're not. If you over diversify, it's hard to make money.
I just went and put it all into WeWork. I heard there's a great deal.
Yeah.
Coming,
I heard that. Oh my
100%.
God. You're gonna be so fine.
Yeah. Hey, so for those who are just listening to this, they don't realize that I went to Patrick's house and I had I found a picture of his cat.
Oh, I know.
And little did I know that it's just like Patrick's always so bearish. His cat looks like it was staring at me.
I bleached that in there, right? I bleached that.
Yeah, you probably. Animal control is going to be coming next week.
Okay, I dyed it, not bleached it.
Yeah. Okay, so thanks a lot for everyone. Thanks to Daniel. Make sure you stick around because you're going to hear him again in the after hours. For those who missed the beginning of the show, don't forget Market Huddle meetup on September 20th at the Rec Room in Toronto. I realized, Patrick, we said the place, we said the time, we didn't say the address. Let's just do that.
Oh my
Rec
God!
Room right now.
Oh my God!
While we're doing this now, Rec Room Toronto.
Hold on,
and
no.
Sure
it's on the here. Hold on.
255 Bremner Boulevard, Toronto, Ontario. 7:00. It's going to.
It's right across from the big aquarium. The Ripley's.
Right
aquarium.
across from the Ripley's Believe It or Not aquarium in around Skydome. Come, it's going to be a lot of fun. Everyone's invited.
Rogers Center. No one knows what the Skydome is anymore.
Oh, really?
It's Rogers Center, isn't it?
Oh, I don't know. That sounds more right. What do I know? I think it's still like the Carling O'Keefe
Anyway,
Center.
it's going to be great. Tracy's coming out. Tracy, Chai Girl. We'll talk oil. We'll talk all sorts of fun stuff.
What anyone ever wants to talk about, as long as it's not sours, and it'll be a lot of fun.
Oh,
Anyways,
yeah.
Thanks.
Go for
Patrick. Why don't you tell everyone where they can find you?
Oh, you can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna.
And I'm at Kevin Muir. And thanks for listening. And make sure you stick around for Daniel. Okay, joining us now in the after hours is Daniel Want from Prerequisite Capital. Daniel, when we were kind of chatting in the pregame, you mentioned that you've recently moved, and there was actually some black swans out in your front lawn or in the waterway around you. Is that true?
Yeah, no, definitely. We have.
You weren't just pulling our leg, like you weren't just saying that the The black swans, and you said there's two of them. Do two of them negate themselves? Like, is that like
I don't know how that works. I've seen three, but that's the extent of it. But yeah, they tend to. It's quite amusing. I mean, everyone in our industry sort of gets the joke, but especially if they're talking to me, because I'm usually talking about something to do with banking systems and their vulnerabilities. But
are black swans common in Australia?
Yeah, certain parts of Australia.
Like, is that your regular swan? Like, because we don't have any. Ours are all white.
Yeah, well, at least so. I'm on the east coast of Australia, and the different places I've lived, we tend to be black swans around the areas I've been in.
Sort of like the Australian real estate market, no?
Yeah,
that's right.
Well, depends on the way you look at it and your time horizons. Yes.
Well, listen. So you're out in Australia. Here we're on the other side of the world, up in Canada. So we always love to hear an update on what's going on in the real estate markets out there. So what's your take? I know you did a research piece. I'm going to just put it up here on Australian property. That's a lot of pages to go through all the way, but the question I have for you is like, why don't you give us the rundown?
1 second.
Are you bullish or bearish?
Patrick? But 1 second before you say anything, Daniel, I just want to preface this with that I was actually in San Diego and I met an Australian surfer, and I have it on good authority that the market in Australia is ripping again.
There you go.
Is that true? Is my surfer buddy correct?
Well, it's trying to. We're definitely in an environment where positive surprises are is the season. So yeah, I mean, Melbourne and Sydney property prices are starting to sort of show signs of life again, and our lending aggregates are, arguably bottoming out in terms of the declines they've been in and different things. So there's a lot of, I guess, positive surprises, I guess, is the best way to put it at the moment. I mean, that report you're looking at...
what's your bias, though?
Sorry?
What's your bias, though? Are you do you still see vulnerabilities and risks there, or do you think that that this is now properly mean revert and it's probably going to remain stable here?
So it all comes down to the time horizon. So over the next 12 months, at least according to our methodologies and frameworks, it's still likely to be resilient here. And we're not going to at least be at risk of imminent crash. I mean, and then, on a longer time horizon, a multi-year, say 3 years from now, ish, that's when the real window of vulnerability starts to open up here for a meaningful debt default cycle, unemployment, and obviously that pulls the rug from our banks and our property market. We're definitely vulnerable on a multi-year, multi-decade basis, and definitely overdue for a washout. But there's a lot of dynamics at play here, especially in Australia, that people tend to underappreciate.
Now, the Reserve Bank of Australia has been cutting rates for the last little while. The question I have is, like, has that translated actually to considerably lower mortgage rates?
Generally, yes. The spreads have been starting to. So both, they've more or less been passed on, and also the spreads have been starting to come in a little bit from the wides that they've been at. But yeah, the interest rates, at least in the study and research I've done, at least here in Australia, it can be a little, like in the US, it's a slightly different sort of system, but here it's not, in terms of material drivers of, so interest rates tend to be more coincident to other things that lead. And especially when you start talking about the central bank, all they'd ever do is just react anyway. They're the sort of last of the party, and they trail conditions that are unfolding. Eventually here in Australia, we'll catch up to the rest of the world with zero interest rate policy. I just don't know whether that's, what sort of multi-year time horizon it is before we hit zero. Could be sooner. Could still
Daniel,
be a while.
is that what's driving? Daniel, sorry to interrupt. It's Kevin here. Is that what's driving the recent uptick that we're seeing? Is the fact that as they've aggressively lowered rates, the consumers responding with buying houses again, or is it more to do with what we would have to assume is a credit impulse coming out of China in reaction to the recent slowdown?
Well, actually, probably one of the biggest and underappreciated dynamics of concerning Australia, both our banking system, but especially our property market, actually has to do with the capital flow sort of way of looking at things. So, for example, our entire banking system, if we were to just simplistically define it as central bank and commercial bank assets, is about $2 trillion-ish US dollars. Whereas the banking systems of pretty much the rest of the world that matters is more like $140, $150 trillion. Anytime you get stress in the world, there's a sequencing effect that happens. And by the way, our entire property market here in Australia is capitalized, so land and buildings, a whole lot, is capitalized roughly at about $5 trillion US dollars. And that $5 trillion US dollar market capitalization is actually determined by only about 200 billion US dollars worth of transactions every year, right?
Right.
And so $200 billion US dollars worth of transactions every year determine basically the pricing fortunes or the market capitalization of our property market, which in the scheme of the world is just, we're nothing. We're so small. We're sort of just a ship floating around on a pretty big ocean out there. Now, the dynamic that people underappreciate is whenever there's stress in the world, there's a sequencing dynamic through our currency in particular. Stress in the rest of the world, at T equals 0, so when the stress occurs, tends to have a discounting effect on our Aussie dollar. So our currency falls. And that tends to discount at least a degree of risk in our system and economy. But the dominoes are put in motion, like stress in Europe, stress in Asia especially, but the same holds for pretty much most countries around the world. Stress dominoes into at least part of, the participants in those countries looking for greener pastures to diversify internationally. So you get capital movement and capital is agitated in the world. And of course, Australia basically being on the other side of the world to, Europe and the Middle East. And so, we're pretty much an island nation in the middle of nowhere, more land than we know what to do with, stable rule of law, perfect weather, or depending where you go. But, we have a lot going for us, and reliable capital markets and institutions, all the rest of it. So just even a small bit of that capital exiting the rest of the world, especially Asia and Europe, coming into Australia, because by the time months later that the capital is actually really moving and the stress dominoes have played out, they look at Australia and go, oh, and they've got a slightly cheaper currency too. Let's go in there. And so that then backstops our banking system and our funding requirements, so our credit engine in this system. And then it naturally also finds its way into our property markets. And so on a domestic basis, our property markets and real estate is very much like a confidence asset, like we were talking about before, because of all of the credit that underpins it, and we're over leveraged and all the rest of it. But on an internationalized basis, Australian property is really more akin to a safety asset, right?
Yeah.
And so you can track
it's interesting
those capital flows and those stress events, and that actually leads our property price growth by 12 months on average. And that's one of the biggest drivers.
What's interesting is that I've heard the same type of an argument a couple of years ago from this Kevin Muir guy about Canadian real estate. Kev, do you recall that conversation?
That's right. I said that we're going to be a lot different than the Americans
because
it's basically an outlet valve for when we run into problems that we can let the currency go.
Exactly. So the current what happens is that we have the benefit that a lot of it translates through the currency move rather than the nominal prices of things like real estate. Where like I think what exacerbated the U.S. real estate problem was that the U.S. dollar was skyrocketing at the same time as the real estate and the economy was tanking, right? And that actually made things worse. Is that a fair way of kind of summing that up?
Yeah, I mean, like when you're starting to talk about the US system and where it places in the broader global system, this, it's slightly different setup, but especially for Australia here, it's definitely the case. I mean, our currency is a very valuable shock absorber for a lot of things.
Absolutely. So let's move on to those Australian banks because I know like a year or two ago that one of the most popular things that I kept hearing was everyone like which one of these Aussie banks to short, and that was like something that the way a lot of people wanted to express their bearishness on the Australian real estate market was by going short many of these Aussie banks. What's your take on what the banking system looks like, and what are you noticing here when it comes to Australian banks?
Yeah, I mean, so on a longer term basis, our banks are, they have problems. They're a little bit unbalanced and all the rest of it, and overexposed. And even here in Australia, it's like leverage on leverage on leverage is, like both at a household level, at a banking system level, and then even for the last decade or more, it's like our entire economy has kind of been on the back of that leverage cycle in China as well, and so,
right,
it's not a very, encouraging set of foundations there. But so our banking system, but on a shorter term basis, like when about 18 months ago, when we really started to get serious, mostly because we were contracted by a group here to do deeper dives into our banks and things. All of the usual leading indicators and leading relationships to debt default cycles in Australia, they just were not showing any signs of a debt default cycle anytime soon. In fact, it's just been surprisingly resilient, and still is. And even on all of those leading indicators that have useful, historic experience to the degree that they still matter, which I'd imagine they probably will. We're still at the earliest, probably 12 to 18 months away from any meaningful transition into a meaningful debt default environment here in Australia. And so, and then we had a bit of a funding squeeze at a wholesale level with our banks over the last 18 months. But even that, because of this capital flow dynamic. So we hit basically a lull in capital flows about 18 months ago. Actually about 24 months ago, and that really was what snowballed into, and then we compounded it with a banking royal commission, and you're never going to find good things when you put a magnifying glass over our banks, and so that sort of snowballed, and pessimism got out of control and all the rest of it. But literally, at least according to our models, that capital flow dynamic starts to reverse literally this back half of this year, from literally July onwards. And so we were, loosely, according to those sorts of models, knowing that we didn't really have heightened probability of risk around a debt default cycle kicking off anytime soon. And we knew we were going to have tailwinds coming back in on a capital flow basis, sometime the back half of this year-ish, which then eased off our wholesale funding market tightness and all the rest of it. And now we've got the preconditions. We're actually starting to see those, positive surprises or green shoots that are appearing. It's probably going to just be markets doing what they always do, which is setting up the most people to be hurt. Because what will happen now, if we get more, if these positive surprises tend to snowball, we get a bit of price growth even in, some of the major parts of Australian property, and, lending aggregates are starting to kick back in potentially. 12, 18 months from now, everyone will be, back into it. It's always dangerous talking about property here in Australia because it really is our national religion. And
Welcome.
Same with us here in Canada. We're the similar. Daniel, do you think that the Australian dollar's found the bottom at 67 cents for the time being?
Look, possibly on a shorter term basis, yes. But on a, as the time horizon extends out to, say, a year, 2 years, 3 years, then I'd be pretty surprised if we've seen the bottom. I think it'll go much lower.
Why? Because you just think ultimately the excesses in the real estate market and all of this has to be unwound?
Yeah, well, we have
you mentioned earlier that you're actually sorry, I didn't mean to interrupt. You said earlier that you're a little bit of a dollar bear longer term, U.S. dollar bear longer term. So that also kind of makes me wonder if you're an Australian dollar bull kind of longer term.
Yeah, and when we say longer term, I'm guessing probably, 4 or 5 years plus time horizons, right? As dollar bear, US dollar bear, possibly. Basically, eventually the Fed and the US government will overreact and, to some form of issues. They'll probably turn banking system issues into a currency issue past a point. And that point, I'm guessing, could be in that 4 to 5 year horizon. Could be sooner, could be later. I don't know. Just see what happens. But past a point, they will do things that will really harm their currency, and everywhere else will have already been washed out anyway in most of the currencies around the rest of the world, including the Australian dollar. So on, say, over the next 3-ish years for the Australian dollar, I still think the path of least resistance is lower. But on the other side of a bit of a meaningful washout or a debt default cycle here in Australia, I think people will probably be surprised at how we come back, and even the Aussie dollar potentially could go on quite a run on a 10-year time horizon from now, because we just have a lot of stuff going for us. And once we've had that washout relative to, the different dynamics that are unfolding in the rest of the world, like in Europe and Japan and even China, Australia's going to be looking pretty good, especially because a lot of the world views even the Australian dollar as effectively a hard-backed currency because of our resources and things. And if we've washed out our banking system and the excess in the property markets and things, and we've rebalanced a little bit, then, we've got a lot of stuff going for us on a 10, 15, 20-year basis.
Hey, what? 1 second, Patrick. I want to interrupt. One last question. I'm going to put Daniel on the spot here. So you guys have I think you've gone 25 years without a recession? It's like some crazy number, right,
26, 27. It's starting to get ridiculous.
Yeah.
Well, it's already been ridiculous.
It's absolutely nuts.
But the reason
do you think you manage the next do you think they manage the next slowdown again, managing to skate without a recession? Or do you think you'll finally get the official recession that has eluded Australia for so long?
Oh, yeah, no. In the sort of debt default cycle that I'm talking about that seems to be on the, horizon on a multi-year basis, that's definitely going to be classified as a recession here.
Okay. So you think within the next 3 years,
yeah,
right, within the next 3 years, we get a recession in Australia that ends the streak. So we don't make it to 30.
We might get to 30, but in the next 3 to 5 years, I'd be pretty surprised if we haven't had quite a cold shower.
Right.
So, that's it's so interesting to kind of see. Like, you have obviously this view that this is going to be still a couple years out, but I mean, what risks are there that this? For instance, I personally think that the Canadian and Australian dollars are poised to do incredibly well once the next commodity bull market begins.
Oh, yeah.
But the question of when the next commodity bull market is going to begin is exactly like one of your longer term time horizon scenarios. I mean, we could be years away from a narrative like that. I mean, what is the most immediate risks to your scenario accelerating? Like, you keep talking about this kind of an 18-month plus scenario, but what could go wrong in your mind that would accelerate this to a 2020 story?
You got to understand, we've just been through such a bout of pessimism in our general conditions here, and especially the property and banking story. like our Royal Commission and then just everything else that unfolded has been pretty intense. And the way the banking system has sort of had to find a new footing, and they've, for the last 2 years even, have been really overhauling the way they've, lending standards and terms and all of this sort of stuff. Like they've really had to reshift things. So we've actually, like, that pessimism relative to the actual underlying resiliency of our system, at least for the last couple of years, it really overshot the reality of conditions. We're kind of bouncing back a little bit. And even though we're in an environment of, say, positive surprises for the next 12-ish months or 18 or whatever, or at least to the degree that our frameworks and models and leading indicators and things, stay intact, it's still going to be somewhat sluggish. I don't think exactly we're going to be roaring ahead anywhere. And this is what I was getting at in terms of like setting up markets doing their thing to set up the most people to get hurt. Because 18 months, 24 months from now, if property markets and our conditions start to materially roll over again, I can guarantee you're going to have the majority of participants here in Australia, especially around property and whatever, going, oh, wow, they'll start to see the deterioration in conditions, or even in weakness starting to come into prices again. And they'll go, oh, I'm not going to get suckered out like I did 2 years ago, and they'll ignore that deterioration because a lot of people have really been shaken in this last 2 years. And they'll go, oh, right. In fact, they probably will actually buy into those initial elements of weakening. The problem is that there's, the trap doors are open. And it's just going to keep deteriorating, and eventually they will get trapped. One of the things we did not have in the last 2 years is, even though we've had all of this pessimism, we really didn't enter into any conditions of forced selling of property or anything else. And so, but we will well and truly see forced selling on any swing down, 2 years from, or 3 years from now, if it happens. Because people are just going to be set up brilliantly by the sadistic market that we have, just for a hammering.
So what I want to ask you about is interest rates and the idea of negative interest rates in Australia, because in Canada, we also have not seen negative interest rates, or even interest rates really sustain at zero for any extended period of time. But we've had polos here in Canada, at least in different meetings, talk about negative interest rates, said that if things get bad enough, it's a possibility that they would go there. I mean, in Australia, is there a possibility if the situation deteriorates that they'd go negative there?
I'm not sure. I mean, they're already talking about QE, which is, look, at the end of the day, Australia is really just going to follow the rest of the world central banking precedent anyway. I don't think we're really going to buck the trend in all of that. I don't know. I know the legalities in the US become a bit problematic when it comes to the idea of a negative interest rate by the Fed. But see, and on a market-driven basis, who knows? Like, the biggest problem in the world is that on a multi-decade basis, we've been sustaining underproductive capacity and resource allocation out there. And so the actual productive output is becoming less and less useful, right? And every time that big overhang of underproductive capacity out there starts to shake or wobble in the direction of, say, a debt default or an asset impairment cycle or an unemployment sort of cycle, then authorities everywhere in the world just panic and throw the kitchen sink at it. And all that's done is sustain it. And, it past a point that becomes uncontrollable. You might be able to control nominal yields through policy measures, but ultimately they can't control real yields. And that's where I suspect there'll be sort of Mr. Market, or at least those primary economic dynamics will come back and bite that system.
You know what I think both the Canadian and Australian markets need? they need to follow the lead of the Danish and have negative mortgage rates. Now that would be something that all Canadians and Australians need, right?
Yeah.
That's speaking from somebody that's long house in the cottage there.
Yeah, well, that,
Tuck up his book. Nothing's
yeah, but I mean, isn't that crazy that that there? Like, I actually was a seller on this idea. I said, look, okay, yeah, central banks might put negative overnight lending rates, but there's no way they would ever pass that on to a consumer. And here we have the, in Copenhagen or whatever, like the Danish are like outright offering negative, like half a percentage point mortgage rates in Europe. Like, what the WTF was that? Yeah. Like, that's I never thought in my life that I would see. Like, I don't even know how does that even work? You borrow a mortgage and then you don't pay. You don't pay, make any payments, and then
no. You make payments because it's still amortized.
It's still amortized.
But you're still, the payments you're making is on a principal that's getting reduced by the rate instead of getting increased by the rate.
Jesus Christ! Like, what? That's insanity. But, like, you know what? Like,
but Patrick, it's the solution to everything. Just do more and more monetarism.
Yeah, it is.
We don't need to get in the Daniel doesn't need to get in a fight with us. You hear us fight about that. I know, Patrick, you had one chart you wanted to talk to Daniel about. Why don't you pull that chart up and let's get to the copper versus what is it, gold?
Yeah, this is. I'm glad you put this into your chart book, Daniel, because you know what? Actually, it wasn't Jeffrey Gunlack who recently also talked about the correlation of the gold copper ratio versus the yield. But it is a really interesting ratio, because I've always looked at it as that's the economy, like Dr. Copper, against a safe haven asset such as gold, and using that as an indicator. So what are you sharing with us here on this chart?
Yeah, no, that chart was really just about illustrating the fact that this last 8 months or whatever has really just been it's just a collateral bid. And so, the gold copper ratio is a classic way to illustrate gold's function as collateral. It's pretty reliable throughout history.
Yeah.
And so when you strip out, say, copper, which is, symbolically representative of the broader, economic growth and conditions or whatever, then you're left with that, currency demand or collateral demand component of gold. I mean, it's a bit simplistic, but it illustrates the point. And then obviously with that euro-dollar flow lead, it just basically indicates when things tighten out there in the world, and especially in the banking system, and that broader financial system becomes more risk averse and tightens, then naturally that sets dominoes into motion towards a greater demand for collateral. And we've seen that most definitely. And this is the thing, it's like, because we've seen this run up in gold with inflation expectations falling, with, obviously the real yield has fallen. And so that's, this is that's a step down in sort of growth pricing and expectations more than anything. And then that, in the world we're in and the system we're in, that, any materially lower growth expectation starts to give rise to, a lot of people looking around going, oh, wow, there's a lot of vulnerabilities in this system. Let's just edge closer towards owning some more collateral. And so we've had a bit of a scramble for collateral, this last 8 months. And, it's probably a little bit overdone short term, obviously, but those underlying dynamics, unfortunately, tend to self-reinforce, especially when you're talking about the massive sort of global banking system and the Eurodollar type system. When they start in aggregate or collectively start to tighten up their balance sheets and sort of inch towards the exits, then that has a self-fulfilling dynamic to it. And so that tightens conditions, and then, that becomes reflexive. And so paying attention to what that broader community of actors are doing is pretty huge. And so I still think, collateral over the next 2 years-ish is going to be very well valued, and there's some increasing chances that there are going to be some scrambles for that collateral. Now, I'm still biased towards treasuries as opposed to precious metals if you're going to skew a collateral holding. But that's probably another can of worms.
So, Daniel, I know that I know you're a little bit of a longer term prognosticator, but I'm going to kind of put your feet to the fire and see if I can get a little bit of a shorter term trade out of you. If you had to pick something for the next 3 months for people to have a look at, an idea that the market is either too confident of or is too pessimistic on, what's your favorite thing? Like, we'll make this the last question of the night or of the morning for you, as it is Australia. It is morning in your neck of the woods. But do you mind kind of giving us on a shorter term perspective something that you think people should have a look at?
Yeah, well, so the options pricing, especially in the calls over gold, on a less than 2 or 3 month time horizon, they've really got out of hand. At least by the way we measure and model and map things. And so I'd imagine that's going to come in a bit, some form of a, like I wouldn't necessarily recommend anyone short calls on gold, out of the money short calls or something. But yeah, we tend to, so we've just got these liquidity signals both on gold and on, we got 10-year a few weeks
ago. So you'd be a covered call writer here. So you would
no,
it's the other way. No, Pat.
I'd be selling.
Patrick, Daniel's saying that the demand for calls is through the roof.
Right, which is like selling call premium against your gold position.
Yeah, but I think he's saying that I don't want to put words in your mouth, Daniel, but I believe he's saying that gold's overextended and that gold is due for a pullback. Are you not?
Yeah, I'd rather look at a pullback in gold than a pullback in treasuries if I had to short-term trade it.
There you go.
But
I hear you. That's actually a great call.
I'm not.
I hear you. It's scary either way.
Right. So.
Yeah, I understand. Yeah. We won't hold you to that. You should see the stuff that Patrick says all the time. Don't worry. You won't embarrass yourself any more than Patrick does. Anyways, why don't you tell people again where they can find you, Daniel?
Yeah, so prerequisite.com.au is probably best. And then every so often on Twitter, Daniel J. Want.
Well, thank you very much for joining us. It's a pleasure meeting you, and be careful of those black swans. I hope it's not an ominous development that you brought it to our attention.
Oh, mate, they're awesome to watch, actually. They're very peaceful and placid, and, very graceful.
Yeah, okay.
Oh, okay. Thank you, Daniel.
Thanks again, Daniel.
See you guys. Bye.
Okay, Lena, hop on.
I'm laughing because you didn't know that it's not called Skydome anymore. It hasn't been called Skydome in like forever. I still call it the Dome, though, right? Like Rogers Center just sounds like any other sporting.
So you don't know Carling O'Keefe is actually the Sony, which was the Hummingbird, which is something else.
Oh, yeah, they rename it. Whoever's got the biggest wallet can name it.
Right, but we shouldn't talk about this because this is Toronto-only stuff that not everyone's going to understand. Yeah. So let's talk about something more interesting, which is sours.
Well, this one's Lena, not a sour that we're drinking.
No, it's not. We have to do our review, so no doubt about that. But I just want to let you know that yesterday, Patrick and I went out for some beers. Yes, we drink beer even on our off days. And we were at this bar in his neck of the woods, and I started saying how I can't stand sours, and the lady told me, oh, you just haven't had the right one. You got to try this one. And so she proceeded to give us a little shot glass of this one.
Okay.
And
it was awful.
To say it was awful is giving it too much of a credit. And there was another lady at the bar who she also got a shot of it, and she described it perfectly. She says it tastes like a face mask.
Ew.
It had a hint of like cucumbers
or whatever. So, but then the funniest thing is the bartender who had been selling us on these sours said, I said, this is terrible. Like, I can't believe anyone actually drinks this. And she says, nobody drinks an actual pint of this thing. And I'm like, I'm like, what?
You can't drink a whole pint.
You get a,
Yeah,
you get
we
a
just drink
shot of this.
shot glasses of this thing. Like, it's just
You
so
get you get a
bad.
shot of this shitty beer, so you end up buying more other beers to wash it all down and forget about it.
That's right. It's all part of the elaborate hoax. Okay, so let's go back to our beer today. What do you guys think?
You know what? I actually finished 2 cans of it, so it's not like it's not undrinkable. But you know what it is you have to either be a port guy or
porter
or
is definitely yeah. So Lena, this was your first porter. What did you think?
I thought it was almost like a stout, right? Like it's kind of similar, right? As far as the taste goes, it kind of tastes almost like a Guinness, but like a lighter Guinness, I think.
Okay.
See, I don't mind that darker beer. Like I drink Guinness all the time, but I can't get over that like nugget coffee taste that's in it.
Oh, I love
it. Oh my God.
I love coffee, so this is like, ooh, I can have a breakfast beer from now on.
Oh my God.
Okay, everyone chime
That's
in
a
with their
breakfast beer. Okay, so the review is whether we like the breakfast beer.
Okay. Everyone give their numbers.
All right, Lena, you go.
I'm gonna give this an 8.9.
Oh my God! Holy cow!
This may actually replace my morning coffee.
Oh my God!
Slippery slope.
You know, there's a reason we have Lena on our crew. Okay, Patrick, what do you think?
Yeah. Oh no, I'm not going to give this a high rating. You know what? I don't even go under 5 because I think it's too insulting to the
sponsor.
To the sponsor. So like, I'm going to give it like a 5.9.
Oh,
and that to me is on the low end there.
I'm going to split it. I'm going to say 7.5. It's fine. It's nothing great. Nothing
Oh my God!
So I'm going to just go boring.
You two are insane. I
Okay,
need another sour.
Yeah,
Exactly.
God.
Oh my God. But you know, because we took a couple of weeks of break in August, I was like, oh, I haven't had a beer in a while. I'm like, maybe I'll just try to go with Sober September. And I was like, yeah,
Sober
maybe I'll
September.
do Sober September and not drink for the entire month. And then today came around and I thought,
And it's like,
never
yeah,
mind.
September.
And
nonsense is that?
Yeah, that is nonsense. The only month that people don't drink is like January. They take that like New Year's resolution after an entire December Christmas season of drinking.
Yeah, like a whole 3 days after New Year's, and then you're like, it's snowing outside. I got nothing.
I know a number of people that really go hardcore and just don't drink at all for January. They like
I double it up in January. I figured nobody else is drinking. I better drink double.
There you go.
I'm with Lena. It's cold. It's dark. If you go look at the biggest alcohol drinking countries, they're all the ones in the north.
That's true.
Yeah. Sweden, I had no idea. Complete alcoholics like us.
And it keeps you warm, right? It keeps you warm.
Russia, complete alcoholics.
That's not
Poland.
new.
Otherwise, you get depressed, right?
Yeah. Yeah. You get depressed. Well, it doesn't really help with the depression very much.
I think it's just entertainment factor.
It might be actually part of the problem, but you know what? That's never stopped us. It's just when it's dark at like
3:30 in the afternoon.
Yeah. Well, in Sweden it does get because they're even more north than
exactly.
us. People don't realize it, but if you think about Canada so far north, although we are much colder than Sweden, we're actually not as far north.
Yeah.
There you go.
We don't live in
geography
England.
lesson.
Yeah.
Yeah.
All right. Well, listen, I got to get out of here. You know where I'm going? I'm going to that Game of Thrones symphony.
You don't even know
concert.
what it's called.
No, I don't even know what it's called. I got free
What are you
tickets.
going to? You got a Game of Thrones concert?
Like it's a symphony thing. Like they
So you're going
play.
to the symphony?
Yeah, it's actually at the amphitheater, but they're actually
God.
have like the
So-
whole orchestra there, and they're
Okay,
gonna play like all
Patrick.
the soundtracks.
I got something.
I got free tickets, dude.
Wait, but
Okay, whoa, I got something to tell you.
Yeah.
The Canadian tuxedo is not formal wear.
Really?
better
For
go home
those
and
who don't
change.
know what the Canadian tuxedo is, it's jeans, a jean shirt, and jean jacket.
You mean I have to like actually really dress up?
I think you have to dress up for that.
shit.
Yeah, I think you do.
Speaking of
Are
Canadian
you going with?
tuxedos,
Are you going with Mrs. Big Picture Trading?
No, I got a ticket from a buddy who's got a little group going in, and he had an extra ticket. So I'm gonna just, I didn't even know this was going on. They just texted me like a couple hours.
It's
ago
a bro date tag along.
Yeah.
Somebody bailed, rightfully. Eh?
Yeah.
They're like, oh God. Better come up with some.
And I'm the sucker who took the extra ticket.
That's right.
Whatever.
You're like the.
So wait,
Anyways,
are they
I know-
gonna have like visual things, or is it just?
Yeah, I
distancing,
think there's
or
a
how
whole
does that-
visual thing that I think they have like a big screen and they do like a big visual to accompany.
That's
it
the
or
only
something.
reason he went. He thinks there's going to be nudity. There's not going to be any nudity, Patrick.
Damn it. Damn it.
Okay, so everyone have a great week.
Yeah.
I can't think of anything else. That's it.
Yeah, I know. Listen, yeah, have a great week, and we'll reconvene for next week. We have a great guest. We won't say who it is, but everyone should be looking forward to it, and we'll see you all next week then. Thanks, everyone.
Take care. Bye.